Hey you, ever get that feeling like you're trying to sip from a fire hose when it comes to financial news?
Oh, definitely.
One minute everyone's yelling about the next big thing, the next it's doom and gloom, and you just want to get a handle on things without feeling completely lost.
Yeah, totally overwhelming sometimes.
That's exactly what we're doing here on the Deep Dive, sort of sifting through the noise to find the stuff that really sticks.
Absolutely. And today we're zeroing in on the insights of a true giant in the investing world, Benjamin Graham, and his book, The Intelligent Investor.
Right. The Intelligent Investor.
Now, this was written way back in 1949, so, it might seem a bit dusty.
Yeah, 1949 sounds ancient.
It does, but honestly, the core ideas are just as powerful today. Think of this as getting the cheat sheet to understanding how to invest smartly.
And when we say giant, we're talking about the mentor to Warren Buffett himself. Graham's approach in The Intelligent Investor isn't about those quick wins or, chasing fleeting trends.
No, not at all.
It's about laying down a solid, sensible framework for your long-term financial well-being. So our goal today is pretty straightforward. To break down Graham's key principles so you walk away with a clear understanding of how to navigate the investing landscape intelligently.
Okay, so let's get into it. I think we should start by looking at a really fundamental point Graham makes right at the beginning.
Right.
The crucial difference between being an investor and being a speculator. This distinction, it really underpins everything else he talks about.
Right. An investor versus a speculator. So as Graham sees it, an investor is someone who does their homework really digs into the details, analyzes things thoroughly, with the aim of protecting their initial capital and earning a reasonable return. It's about being careful, focusing on steady growth.
Exactly. And he draws a sharp contrast with a speculator who's much more focused on trying to predict short-term price movements and, time the market.
Trying to guess the ups and downs.
Yeah, and Graham generally felt this was a really risky game for most people. He famously said, "An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative."
Pretty clear cut, right?
Very clear cut. It's a different mindset. Instead of trying to guess what might happen next, you're focusing on the actual value of what you're buying. In today's world, you could almost say the speculator is chasing the latest viral stock tip, hoping for a quick buck.
Right, the meme stocks.
Exactly. While the investor is thinking more about the long-term health of the underlying business.
That makes a lot of sense. It's about adopting the perspective of someone who actually owns a piece of a business rather than just betting on a stock price ticker.
Precisely. You're in it for the long haul, focused on the real value, not just the buzz.
Okay.
And building on this foundation, Graham then describes two main styles of investors: the defensive investor and the enterprising investor.
Defensive and enterprising.
Yeah, and most people will likely find themselves leaning more towards one than the other, and that's perfectly fine. There's no right or wrong here.
So the defensive investor, that sounds like someone who prefers to keep things straightforward. Maybe minimal effort, avoiding major blunders, perhaps someone who's got a busy life, doesn't have hours to track the markets every single day.
You've nailed it. That's exactly the profile. This type of investor favors high-quality, well-established companies, the kind we often call blue-chip stocks.
The big names.
The big names, yeah. And they might also include top-notch bonds in their portfolio for added stability. They're not trying to outsmart the market with risky bets. They're just aiming for consistent, reliable returns over time. It's a more hands-off approach.
Okay, and then there's the enterprising investor.
Yeah.
That sounds like someone who's willing to put in a bit more effort, maybe do some digging.
Exactly. The enterprising investor is prepared to do the research, to hunt for those undervalued gems that the broader market might be overlooking.
Finding hidden opportunities.
Right. They understand that the potential for higher returns often comes with a greater willingness to handle some ups and downs, some volatility in their investments.
So it's not about one being better than the other, is it?
Not at all.
It really boils down to your own personality, how much risk you're comfortable with, and honestly, how much time and energy you're willing or able to dedicate to it.
Precisely. And regardless of which path resonates more with you, understanding market psychology is absolutely key. This is where Graham introduces his really insightful idea of Mr. Market.
Oh, I really like this one. It paints such a clear picture. So Mr. Market is like your daily business partner who shows up and offers to either buy your shares or sell you his, right, every single day.
That's the essence of it. And the crucial thing to understand is that Mr. Market's mood swings wildly.
Yeah.
One day he's incredibly optimistic and offers sky-high prices. The next, he's completely pessimistic and practically giving shares away at bargain basement prices.
Like that one friend who's either on top of the world or in the depths of despair, with no middle ground.
Exactly. We all know someone like that. And Graham's core point is that you, as the intelligent investor, don't have to get caught up in Mr. Market's emotional roller coaster.
You don't have to play his game.
You don't. You can observe his offers, but you don't have to trade just because he's feeling particularly happy or sad. In fact, you can actually use those mood swings to your advantage.
How so?
Well, as Graham famously said, the intelligent investor is a realist who sells to optimists and buys from pessimists.
Ah, okay.
Think about how amplified Mr. Market's volatility can be today with, constant news updates, social media.
Oh, yeah, 24/7.
It's even more important to stay grounded and not get swept up.
So when Mr. Market is all excited and prices are high, that might be a good time to consider selling some of your holdings.
Potentially, yeah. If the price seems irrationally high compared to the value.
And when he's feeling gloomy and prices drop, that could be a golden opportunity to buy shares of good companies at a discount.
Exactly. It's about being the calm, rational one in the partnership. Thinking for yourself.
Right. Not getting carried away by the crowd's emotions.
Precisely. And this leads us perfectly to what Graham considered the absolute bedrock, the cornerstone of intelligent investing. The margin of safety.
Ah, yes, the margin of safety. This sounds like that crucial bit of wiggle room, that extra cushion in case things don't go exactly as planned.
It is absolutely fundamental. The whole idea is to buy assets for significantly less than what you genuinely believe they're worth their intrinsic value.
Okay, intrinsic value.
That difference, that discount you get, is your margin of safety. It acts as a buffer against all sorts of uncertainties. Maybe your initial analysis wasn't spot on. Maybe the company hit some unexpected turbulence. Or maybe the market just takes a temporary downturn.
So it protects you.
It's about protecting yourself from permanent loss. That's the key.
Can you give us a simple, real-world kind of example to really nail this down? Something relatable?
Sure thing. Imagine you've really done your research on a particular small business, maybe a local bakery that's been doing well for years.
Okay, love a good bakery.
Right. You figure based on their sales, their loyal customer base, their assets, maybe their equipment, that the entire business is worth around, let's say, $500,000.
Got it.
Now, if you had the chance to buy that entire business for, say, $350,000...
Much less.
Yeah, that $150,000 difference, that would be your margin of safety. You're getting it at a significant discount to what you believe it's truly worth.
I see.
As Graham wisely put it, the margin of safety is always dependent on the price paid. The less you pay relative to what something is truly worth, the bigger your safety net.
Okay.
Now, when we're talking about stocks, trying to quantify that intrinsic value can be trickier, sure, but the principle remains exactly the same.
Okay, that makes perfect sense. So how does this idea of margin of safety translate into practical steps for someone looking at the stock market? What does that look like?
Well, as our key takeaways highlight, applying this principle in the stock market might involve looking for companies whose stock price is significantly below the value of their net current assets.
Net current assets.
Yeah.
Was that again, basically?
That's essentially their liquid assets, like cash and things, easily converted to cash minus all their liabilities, all their debts.
Okay.
It could also mean seeking out bonds that are trading at a discount to their face value, focusing on companies that have a low level of debt compared to their equity.
Less risky debt-wise.
Right. Or preferring stocks with price-to-earnings ratio, PE ratios that are below the average for the market as a whole. These are all ways an investor tries to build that margin of safety into their investment decisions.
So you're looking for situations where you feel like you're getting more value than what you're paying for.
Exactly. You want a bargain, but a bargain based on real value, not just a sales sticker.
Got it. So it's about being a bit like a savvy shopper, always on the lookout for a good deal, but with a really clear understanding of what constitutes a good deal based on solid analysis, not just a flashy price tag.
Perfect analogy.
Now, Graham also talks about how to balance your portfolio between bonds and stocks.
Oh, right.
Right. He didn't just say buy cheap stocks.
No, he definitely didn't. Particularly for the defensive investor, Graham often recommended maintaining a well-thought-out balance between high-quality bonds and blue-chip stocks.
Why that mix?
Well, this diversification helps to provide stability to your overall portfolio. When the stock market might be experiencing a downturn, bonds can sometimes act as a counterbalance, providing a bit of a cushion, and vice versa. It's about not putting all your eggs in one basket and having a mix of assets that behave differently under various market conditions. Reduces overall risk.
And he wasn't a fan of chasing those really high yield, but also really risky junk bonds.
Generally not, no.
Or those super hyped up growth stocks that don't really have a solid financial foundation.
Exactly. Without that significant margin of safety we just talked about, those types of investments, in Graham's view, edged much closer to speculation than to intelligent investing.
Right. Back to that first point.
Yep. His primary focus was always on protecting your capital first and foremost. Adequate return second, but safety first.
Okay. Now, when it comes to actually picking individual stocks, what were some of Graham's key guidelines, both for that more cautious defensive investor and the more active enterprising one?
Good question. For the defensive investor, the emphasis was on well-established, large companies.
The blue chips again?
The blue chips, yeah. Companies that have a long and consistent history of being profitable and paying dividends. Strong financial health things like low debt and stable earnings were crucial.
Makes sense.
And also reasonable valuation metrics like those price to earnings and price to book ratios we mentioned. You're looking for the reliable, steady eddies of the market.
So think as those big, well-known companies that have been around for decades and are generally seen as pretty stable, solid, maybe a bit boring.
Maybe a bit boring, but potentially safer. Now for the more adventurous, enterprising investor.
Okay, the ones willing to do more homework?
Exactly. Graham suggested looking at smaller, perhaps less well-known companies, or situations where a company might be temporarily undervalued by the market for some reason.
Like they're out of favor.
Could be. They might look for stocks trading at a price below their book value. That's their assets minus their liabilities.
Getting assets on the cheap.
Sort of. Or companies that have strong underlying businesses, but are facing some temporary negative sentiment in the market. However, even for the enterprising investor, the core focus remained on those fundamental business realities.
So things like how the company has performed over time in terms of earnings, whether they return profits to shareholders through dividends, the strength of their balance sheet, their competitive position within their industry. Like, do they have a moat?
Good point, yes. And even the quality and integrity of the people running the company, the management, you're looking at the real engine of the business.
Right, not just the stock price.
Exactly. As Graham famously said, in the short run, the market is a voting machine, but in the long run, it is a weighing machine.
Explain that one a bit more. Voting versus weighing.
Sure. In the short term, stock prices can be heavily influenced by popularity, sentiment, news like a popularity contest, a vote. But over the long term, the true underlying value and performance of the business, its weight, its substance will ultimately be reflected in its stock price. The market eventually figures it out.
That's a really powerful way to think about it. So instead of getting caught up in the day-to-day noise and fluctuations, the intelligent investor keeps their focus on the actual substance and long-term prospects of the company.
That's the goal, yes.
Now, what about those times when the market as a whole gets a bit bumpy, or a lot bumpy? How did Graham advise navigating those inevitable ups and downs? Panic.
Definitely not panic. He actually encouraged viewing market downturns not as reasons to freak out, but as potential opportunities.
Opportunities. When everyone else is selling.
Especially then. When the market experiences a significant drop and good quality stocks suddenly become available at lower prices, that's precisely when the intelligent investor should be looking to buy.
Buying low.
It goes right back to that idea of being a buyer when others are selling out of fear. It requires a bit of a contrarian mindset going against the herd sometimes.
So a market correction or even a crash isn't necessarily a disaster. It could actually be a chance to pick up some really good investments at a bargain price.
Potentially, yes.
If you've done your homework and know what you're looking for.
Absolutely. That's why having a watch list of companies that you've already analyzed and would be interested in owning at the right price is so crucial.
Being prepared.
Exactly. You have your targets in mind, and when the market presents those opportunities, you're prepared to act decisively, not emotionally. And it ties back to that core principle we discussed earlier.
Let me guess. Sell to optimists, buy from pessimists.
You got it. The intelligent investor is a realist who sells to optimists and buys from pessimists. It's a recurring theme because it's so central to his entire philosophy. You have to repeat it.
Okay, makes sense. Now, Graham also really emphasized the importance of actually understanding a company's financial health, right? wasn't enough to just look at the ticker symbol in the stock price graph.
Absolutely not. He stressed the absolute necessity of analyzing a company's financial statements.
The boring stuff. Balance sheets, income statements.
Maybe boring to some, but vital. The balance sheet, which gives you a snapshot of what a company owns and owes at a point in time.
Okay.
The income statement, which shows its profitability over a period like a quarter or a year.
Right.
The cash flow statement, which tracks the actual cash coming in and out of the business, super important.
Why super important?
Because earnings can sometimes be manipulated with accounting rules, but cash is harder to fake. Cash flow shows the real lifeblood.
Gotcha. Cash is king.
Pretty much. And Graham even pointed to the often overlooked footnotes in those reports.
The tiny print.
Yeah, the tiny print. It can contain crucial details about accounting methods, risks, debt covenants, really important context. These documents reveal a tremendous amount about a company's true financial condition.
So you can judge its profitability, how it manages debt, its overall strength.
Exactly. It's all part of conducting that thorough analysis that's essential for determining that all-important margin of safety.
It all connects back.
It really does. As our key takeaways succinctly put it, the secret of sound investment in 3 words: margin of safety. And understanding the financials is a key way, maybe the key way, to determine if that margin truly exists.
So it's not just about glancing at a few headline numbers. It's about really getting under the hood and understanding how the business operates financially.
You have to. And Graham was a big proponent of focusing on companies that had a proven track record of strong, consistent financial performance, not just a one-hit wonder.
What did that look like for him? Consistency.
He favored companies that had demonstrated consistent growth in their earnings over time, maintained healthy profit margins, meaning they keep a good chunk of revenue as profit.
Makes sense.
Generated a strong return on the money invested by their shareholders, what's called return on equity or ROE.
Okay.
Kept their levels of debt at manageable levels, not over-leveraged.
Right.
Had a history of paying consistent dividends to their shareholders, sharing the profits.
Nice bonus.
And possessed some kind of sustainable competitive advantage within their industry. That moat we talked about.
So something that protects them from competitors just eating their lunch.
Exactly. These are the hallmarks of high-quality businesses that are much more likely to deliver dependable long-term results. And, as our key takeaways wisely remind us, the stock investor is neither right nor wrong because others agreed or disagreed with him. He is right because his facts and analysis are right.
So it's not about popularity. It's about being correct in your assessment.
Precisely. It all comes down to doing your own rigorous work and forming your own informed opinions based on evidence.
Now, we can talk about numbers and financial analysis all day, but Graham also recognized something else, right? That one of the biggest hurdles for investors isn't the market itself.
No.
But their own emotions. We're our own worst enemies sometimes.
That's absolutely correct. He famously said that the investor's chief problem and even his worst enemy is likely to be himself.
Wow. That's blunt.
It is, but it's often true. Fear and greed are powerful emotions that can lead to impulsive and often detrimental decisions.
Like what?
Like buying high when everyone else is excited, and euphoric FOMO, fear of missing out.
Yeah.
And selling low when the market takes a downturn and panic sets in. Selling at the bottom out of fear.
Right, locking in losses.
Exactly. These emotional reactions can completely undermine even the most well-thought-out investment strategies.
It's so true. It's easy to get swept up in the excitement when everyone's talking about a particular stock going to the moon, or to feel that pang of panic and want to sell everything when the market starts to look shaky.
It's human nature.
It really is tough to stay level-headed sometimes.
Exactly. That's why Graham constantly emphasized the critical need for discipline, patience, and rational decision-making in investing.
Discipline and patience. Not easy.
Not easy at all. Sticking to a well-defined investment plan, especially when your emotions are screaming at you to do something different, is absolutely crucial for long-term success.
So how do you do that? How do you fight your own brain?
Well, he suggested practical strategies, like having a truly long-term perspective thinking in years or decades, not days or weeks.
Okay.
Consciously avoiding impulsive reactions to short-term news and market noise. Maybe turn off the constant updates.
Good idea sometimes.
Regularly rebalancing your portfolio, selling some winners, buying some losers to maintain your desired asset allocation, forcing yourself to be disciplined.
Systematic approach.
And even employing dollar-cost averaging, investing a fixed amount of money at regular intervals, regardless of market ups and downs, it takes the timing decision out of it.
Right. Just keep investing steadily.
These are all ways to help keep those powerful emotions in check. Building that emotional resilience is a key part of being an intelligent investor, maybe just as important as the analysis.
So it's almost like you need to build a bit of an emotional shield around your investment decisions to protect yourself from those impulsive reactions.
That's a great way to put it, an emotional shield based on logic and your plan.
And at the very core of Graham's philosophy is this really fundamental distinction between the price of something and its intrinsic value, right? We keep coming back to this.
Absolutely. He consistently reiterated that price is simply what you pay for an asset.
The number on the screen.
Yeah, whereas value is what you ultimately receive, the actual worth.
Okay.
Warren Buffett, his most famous student, famously summed up Graham's core belief with that very simple and profound statement. Price is what you pay. Value is what you get.
Price is what you pay. Value is what you get. Simple but deep.
It really is. The intelligent investor is constantly focused on identifying those situations where the market price of a stock or another asset deviates significantly from its underlying intrinsic value.
Looking for mismatches.
Looking for mismatches, ideally where the price is significantly lower than the value. That's where the opportunity lies.
So you're actively looking for those opportunities where the market might be temporarily undervaluing a fundamentally good business.
Precisely. And equally important, being very cautious of situations where the price seems completely disconnected from the actual worth and long-term prospects of the company, which leads us naturally...
Let me guess.
Yeah.
Don't chase the hype.
You're learning. It leads us to Graham's strong caution against getting caught up in market hype and excessive enthusiasm, especially around those high-flying growth stocks and newly issued initial public offerings, IPOs.
Yeah, those shiny new things that everyone's talking about can be really tempting. But Graham had definitely raised some red flags about them, didn't he?
He certainly did. He pointed out that these types of investments often come with really inflated valuations and overly optimistic expectations baked in from the start.
Setting them up for failure.
Well, setting them up for potential disappointment, certainly, which can very easily lead to significant financial losses when those expectations don't pan out. Reality bites sometimes.
So what were those red flags he mentioned? Things to watch out for.
Yeah, he specifically highlighted things like extremely high price-to-earnings ratios that aren't supported by actual current earnings.
Paying a lot for future hope.
Exactly. Rapid revenue growth that isn't translating into real and sustainable profits. Lots of sales, but no profit.
Burning cash.
Could be. Overly rosy and perhaps unrealistic projections from company management. You have to be skeptical of forecasts sometimes.
Okay.
A lack of a clear and defensible competitive advantage. No moat. What stops others from doing the same thing?
Right.
And even situations where the company's own insiders, the executives, the directors are selling off large amounts of their shares.
If they're selling.
It might not be a good sign, right? Maintaining a healthy dose of skepticism and always sticking to your own fundamental analysis, your own homework, is absolutely key in these situations. Don't just believe the hype.
So it's generally wise to be a bit of a contrarian, maybe, and not just blindly follow the crowd into whatever happens to be popular at the moment, especially if it looks too good to be true.
That's a very Graham-like approach, yes. Healthy skepticism.
Okay. And finally, one last big principle. Graham also emphasized the importance of diversification as a critical strategy for managing investment risk. We touched on it with bonds and stocks.
Absolutely. He strongly advocated for spreading your investments across different asset classes like stocks and bonds, maybe real estate or other things,
Okay.
as well as across a variety of different industries. So you're not too exposed if one sector hits a rough patch.
Don't put all your money in tech stocks, for example.
Right. And even across different geographical regions, different countries.
Why different regions?
Well, economies in different parts of the world don't always move in perfect sync. Diversifying geographically can smooth out returns and reduce risk further. It's all about applying that common sense wisdom.
Don't put all your eggs in one basket.
Exactly. Applying that to your investment portfolio. It's a fundamental risk management tool.
Okay. So to try and bring it all together then, it sounds like the core message from Benjamin Graham, even though he wrote this, over 70 years ago?
Yeah, incredible.
Is really about being rational, doing your own thorough research, taking a long-term perspective, and always prioritizing the safety of your principal getting your money back.
Crucial.
And the underlying value of what you're buying over short-term speculation and market hype.
That's a perfect and concise summary. His principles, although established in a very different market environment, pre-internet, pre-24-hour news, they provide a truly timeless and enduring framework for building wealth intelligently and, maybe just as importantly, avoiding many of the common pitfalls that trip investors up.
It really feels foundational, and this deep dive has really just scratched the surface, hasn't it? There's so much more in The Intelligent Investor.
Oh, absolutely. The book is dense, but incredibly rewarding. We wholeheartedly encourage listeners to delve into the book itself for a much more comprehensive and nuanced understanding of these crucial concepts.
It's probably one of those you read more than once.
Definitely. It's one of those books that rewards careful and repeated reading as you gain more experience in the investment world. You pick up new things each time.
So as you take all of this in, here's a final thought to maybe chew on. Given the nonstop flow of market information, opinions, tweets, everything in today's digital age.
It's constant bombardment.
It really is. How can each of us best cultivate that crucial emotional detachment and maintain the long-term focus that Graham so powerfully advocated? How do we stay sane and rational with all that noise?
That's the million-dollar question today, isn't it? Definitely something worth considering as you navigate your own investment journey.
Indeed. Well, we sincerely hope this deep dive into Benjamin Graham's principles has provided you with a solid and valuable foundation.
We hope so too. And we're always eager to explore new topics, so please do let us know what areas of interest you'd like us to delve into in a future deep dive.
Yeah, let us know. Thanks so much for joining us today.